Hey, this is Edward with acquisitions.com. Today I'm going to record a guide on how to buy businesses. I'm going to get as raw as possible. I'm going to actually build this up with you. So just pay attention to how this works. If you're not yet sure what this is, then still look at the video because you're going to understand how to buy companies. So we're going to get going doing this stuff. So first of all, why should you actually even buy business in the first place? So if you look at business models in general, the biggest issue with business models is that you need to start them from scratch. You don't have any revenue, you don't have any profits, you don't have any clients, you don't have any brand, no recognition, no reviews, nothing, which is quite complicated because over time, while you're building up these assets or these businesses, you still have a very high failure rate, which means you're still going to put in a lot of resources, time, and capital into them, but then at the end of the day, you're still going to fail because of not just necessarily yourself, but based on how the market works and how businesses work in general and statistics. So it's worth looking into something like this, which is buying a business, which you would get into an asset that is already producing cash flow and producing liquidity and producing something of value to you as a buyer. The biggest issue with buying a business is that most people just don't know where to start. So this is what we're going to cover in this video, is we're going to walk you through the most basic process of looking into acquiring a company. And at this stage, I'm going to assume you don't know anything about the process. Or if you know anything about the process, you can still watch the video to get some ideas. Okay, so the most important thing is really understanding what businesses you want to get into, right? So that's the main thing is really picking a market to go after. Okay, that's going to be the first thing you're going to really need to consider. At acquisitions.com, we serve a very particular market in between $1 million in value up to $10 million in value. The reason for that is because if you're completely brand new in the space, it's actually easier to get into a smaller deal in between 1 million and 10 than to go into $100 million deal right away if you don't have experience doing this stuff. So that's the first reason. The second reason is there's a lot of volume of deals available. There's a lot of people looking to sell in that range. So you need to consider that component. You might buy a $2 million company, a $3 million company, a $5 million company, and go up to 10. If you go too much above 10, what happens is there's a lot more people that have a lot more access to capital, such as family offices, small cap funds, private equity funds, and in general, like more sophisticated investors that can just come in and pay a lot more and just give a deal, essentially steal the deal from you. So get it done way quicker than yourself. So what you want to do when you're doing it your first time is you want to get into a deal where the value is a little bit lower, there's less competition as far as buyers and liquidity from buyers, and somebody's probably going to get a loan to buy the business, so they're not going to use only their own capital. Okay, so that's the first thing you need to do. After you pick the market, is you really need to understand how to find deals. And there's only two ways on how you can find deals. There's um, off market, which means you directly will reach out to a company to find the business for sale. And there's on market, which means you will essentially see a deal on a listing site. Popular listing site on the US is bizbuysell.com or loopnet.com. So you'd go on a lot of these websites, you'll filter them, you're going to see what's available, what brokers you can work with, and you're going to go and reach out. That's on market. Off market is a lot more complicated because you need to understand how to do it. You need to understand how to find the leads, how to reach out to them, how to create interest, how to ask them questions, and typically you need to educate the seller a lot more. But then off market is a lot more profitable because one, there's less people doing it. Two, there's more genuine conversations happening between the seller and yourself, a buyer. And sometimes you can even find creative deals. We've done creative deals where people have paid almost nothing up front, and then they pay the rest of the money through seller financing or through some sort of seller note, or maybe got a down payment from an investor, put some money down, and then paid, let's say, 70, 80%, 90% seller financing later. So finding deals, that's the second thing you need to do. Third thing is you need to really um, understand how to position yourself before you start getting in contact with these people. Because if you don't know how to do that, a lot of people are going to disqualify you fairly quickly. What that means is how you're positioning yourself on LinkedIn, um, how you're positioned yourself on websites. Maybe you have a website, or maybe you have a landing page that describes your bio, your experience, or something like that that clearly stipulates what you've done in the past, what you've been successful in, and also that describes your investment criteria or what is called your buy box. If you don't have these things, people are gonna not understand why you reached out to them. People are gonna have a lot of questions, and you're gonna actually answer a lot of these questions before you even hop on a lot of these calls with these people by describing that on your a lot of these pages that you can create yourself. Now, if you're in a corporate setting, you might not want to use LinkedIn because you have a job still, so that might be not a very good idea. But if you have some sort of domain on the side and you can actually describe what you're looking for as far as a business, and then you reach out to a ton of brokers and you reach out to a ton of sellers, well, what is going to happen is that page is going to help you to position yourself in a better way to answer the questions that they need to know about. So that's the thing you need to do as well. It's called market positioning, explaining why you're different, explaining what kind of buyer you are, explaining how you're going to do the deal, how you're going to finance the deal, and kind of educating these brokers and sellers on how you're going to do business with them. So that's very important. Once you've established contact with these individuals, brokers or sellers, you're going to need to understand how to do a phone call with them. It's typically done through a phone call or Zoom call. So just call number one. So you're going to do a call with them. They're going to ask you specific questions. You're also going to ask them specific questions about the process. You need to position yourself as a trustworthy buyer that knows what we're doing and knows how to ask them questions and knows how to move to the next step. If you're not going to be able to do that, nobody's going to give you access to any financials. They're going to just request, in most cases, proof of funds and financials. You're not going to get through the broker. You're not going to be able to get through the numbers. So that's what you would do. Meaning you need to have a more scripted process, questions, answers to very specific questions they'll have for you. So that's very important to structure. Everybody is going to be a little bit different. How they talk, how they answers a lot of their questions, but the main thing is your confidence level. If you're not confident as far as who you are and what you're going to be providing to them, nothing's going to happen. They're not really going to take it very seriously. So that's what you got to realize. The next step after you do the phone call, in the phone call, is that you're going to ask for basic financial information. So you need to actually get in not the information that you got from some sort of website that they have or some description that they give you, but actual financials from an accounting standpoint. Is you want to see the P&L, you want to see the balance sheet, you want to see the taxes, you want to understand what this business is actually doing. You want to see the organizational chart, you want to see how many employees they have, you want to understand what the business is doing. Because if you don't have these things, you can't really create an accurate understanding of what's happening and what's the value of a company. Once you have these things in place, typically you're going to get them after you sign an NDA. So you're going to sign an NDA with this private business and they're going to send you numbers. Once that happens, you can clearly look into the numbers. So you're going to do analysis and you're going to model the deal, which means you're going to want to see the net profit of a company. You're going to want to see what's the value of that company and put a value of a company, right? So next step is valuation. There's a lot of ways on how you can value a company. The more simple way of valuing a company is multiples on net profit. So you're going to look on the last 3 years of a net profit of a company, and you're going to create an average of a net profit of the last 3 years. Sometimes that can be seller's discretionary earnings of a company. Sometimes that can be just EBITDA, so the EBITDA of a business. So you're going to attach a multiple on that net profit. That depends on the sector, and it depends on the weaknesses and strengths of that company. So if that company has a lot more risks to it, that multiple is going to be lower. If that company has a lot more strengths, that multiple is typically going to be higher. You could research different tools, such as BizBuySell has the valuation tool, and it gives you some means and averages and statistics on this. But you need to keep in mind a lot of these tools are still not accurate. At the end of the day, what's really important is making sure you're able to pay off a business and you're not putting too much leverage on the business with debt. I'm going to explain that a little bit further when you get into it, when we get into that. So when you uh, put a multiple of a business, there's a term called debt service cover ratio. So DSCR. If that number is essentially lower than 1.5, it's not a really very good deal. What that really means is how much debt you're putting the deal and how much the company is profiting. If that number, the profit divided by the total debt, is actually less than this number, then what happens is you have a fairly profitable company that is able to pay the debt service. Because in most cases, when we're going to do a broker deal or we're going to do even an off-market deal, we want to go and get a loan against the business. We don't want to just use our own money. We want to use a loan to be able to buy the asset so that we can pay it off in time. We don't want to just use all our liquidity to go and buy the company. So this is why you need to understand what debt service cover ratio is and how that's going to impact the value. If this number is above that number, then you're fairly good to go and get lending. That means you can go and talk to lenders. That means you can go and get some investors in the game and you can start doing the deal. Once you realize this, you can make an offer, an actual contract written by you, and you can write it down without your lawyer. You don't need a lawyer to do this. You want to specify the value and basic terms and conditions, such as this is how much we're going to pay, and this is how we're going to pay it. And then there's, of course, there's a lot more things related to this, but this is the basic concept of an offer is the value and the terms. So that way, when you're starting the process of negotiating, then they know where to start from. And it's typically the offer is going to get rejected. You're going to need to renegotiate. So there's going to be a lot of renegotiation happening. So if we're going to change the terms, or if we're going to change their pricing, or if we're going to have different expectations. And there's going to be a sequence of offers, right? So you're going to go back and forth with these individuals until somebody's going to say yes, and your offer is going to get accepted. Once your offer is accepted, that's really when the game actually starts. Because till this point, you've just tried to earn their trust. You've tried to essentially do some initial due diligence of a deal. You valued the company, you made an offer. You could do this in literally in a week. In a week, you just go and find a deal. You look at the numbers, you make an offer, you get it accepted. I've had guys that we worked with that have done this in 2 days, 3 days, we got an offer accepted. But challenge is, what do you do after that? And you need to have very clear knowledge and you need to actually properly do due diligence of a company. So once you have an offer accepted, in most cases, you will need a few $1 million to close the deal. So you're not going to be able to just use whatever money you have in most cases, unless you're extremely wealthy and you can just take the risk and you can do that, right? But let's say you found an $8 million deal, right? And the offer's been accepted, right? In most cases, you're going to need to get that capital from somewhere. It's going to be either a debt provider, it's going to be either an SBA loan with an additional debt provider. An SBA loan is a government type loan, or if you're in the West, it's going to be probably an SBA loan plus some debt, plus some equity, which is a private investor coming in the deal. And there's a lot of different ways on how you can raise capital. But at the end of the day, you're going to need to raise it. This is what you got to understand. This is the caveat to how you can do the deals. Is you're going to get very good at actually raising the capital and putting the deal together. This might take up to 90 to 120 days to do that. While you do this, while we raise the capital, debt, equity, whatever we need, we're gonna hire accountants and lawyers. And the reason we need accountants and lawyers in that region, so let's say you're in United Kingdom, you're in London, and you want to do a deal, and you found a deal. So you need accountants and lawyers in that region. Let's say you have a deal in Toronto or you have a deal in New York. You need accountants and lawyers in that state. Why you need them is because they will do what is called QE, quality reports, and they will do legal due diligence of a company and financial due diligence as well. The way these individuals get paid is sometimes for delayed fees, what is called, which is essentially they will get paid after the deal is closed, not before the deal is closed. Sometimes they do charge a retainer initially, and then they charge the delayed fees later. So you need to understand that once you're getting into the deal. You might need to pay $20,000+ to up to $100,000 to close a deal like this. It depends on what accountants you're talking to or what lawyers you're talking to, their experience level, the size of a deal, the market, and so forth. So I can't tell you the fees, but in general, this is what you need to understand. If you're going to do delayed fees, you can get these fees from a bank. So when the bank gives you the loan against the business, they can give you additional working capital. That's included in that initial loan or commercial loan you got. Which means with this working capital, one is you can pay these accountants and lawyers, and two is you can also pay yourself if you want to, when you're going to be the new owner of that new business, operating the new business. So this is what happens, right? This is the overall process from start to getting the loan, doing the due diligence, and closing the deal. And there's a closing date when you actually will transfer money. Everybody's going to sign a purchase agreement, and the owner is going to sign, but the former owner is going to sign a purchase agreement with you. You're going to become a new owner, and things are going to be happening. You're going to basically start operating the business, and there's going to be typically a 60 to 90-day period of post acquisitions procedures you need to do to improve a business, to put the right people in the right seats, or just make sure you understand how everything works. You're gaining momentum with a company, right? So that you can start a second acquisition or start doing more. This is essentially what you need to understand about buying a business. These are the steps, the in-depth steps. Of course, there's a lot more details to this, right? It's not just the 17 steps. I'm just trying to make it very simple for you. Now, if you want to learn a lot more, if you have very particular questions, you can just directly message me on my Instagram because I can't actually post these Google Docs in my YouTube channel for some reason. So what you're going to need to do is you're going to need to directly message me on Instagram. And you can say whatever you want as far as the process, and I'm going to try to help you that. Now, we also promote a lot of deals. So we work with a lot of people. We consult a lot of people in deals. So if you're an investor that has liquidity in above in between 100K up to a million liquid, we're looking for always a lot more liquidity. Why? Because we have clients that need that liquidity to be able to close more deals. So if you want to be involved, maybe like a passive minority investor in the deal, you could also directly message me and I'm gonna put you in contact with different people and different deals we're looking for. We're looking at a deal right now that we need to get close to 650 in equity. We have another deal where we need $1 million. We have another deal that we need $550,000. We need another 300K on another deal. We need just another 60K on another deal. So there's different kinds of deals we're doing that we need down payments for. So if you want to be involved, you could also directly message us. A lot of these deals are already on these specific situations. So if we've completed all these steps, the offer's accepted. You don't need to do all the heavy lifting. We've already done it. So you can get in the game a lot quicker. Okay? So we just need to raise the final portion of capital. And a lot of these deals already have a portion of capital raised from the banks. They just need to give a down payment to be able to give a loan. So this is pretty much it as far as the video. If you want me to just make videos like this, or if you have more questions, let me know. But this is pretty much it. Thank you.